In July 2025, the U.S. labor market showed clear signs of slowing. Only 73,000 non-farm payroll jobs were added, well below economists' expectations of 104,000, and marking a notable deceleration compared to earlier in the year. The unemployment rate rose slightly to 4.2%, up from 4.1% in June, and reaching its highest point in over 2 years, which aligns with consensus economic forecasts. This shift reflects a softer jobs market after months of relative stability, with the unemployment rate having hovered between 4.0% and 4.2% since mid-2024. Importantly, prior months' data were revised sharply downward. May and June saw 258,000 fewer jobs added than previously reported. In June, for example, the initial tally was 14,000 new jobs, but this had been overestimated in earlier releases. Other labor market signals point to further cooling. The labor force participation rate slipped to 62.2% from 62.3% in June, a sign fewer people are working or looking for work. Average hourly earnings grew by 3.9% year over year, marginally outpacing expectations but not signaling significant wage pressure. Job openings fell to 7.44 million at the end of June from 7.71 million the prior month, and the hiring rate dropped to 3.3%, the lowest since November 2024. This weaker jobs report follows the Federal Reserve's July decision to hold interest rates steady, with officials noting a solid but gradually cooling labor market. Fed Chair Powell remarks that while job growth has slowed, labor supply constraints such as lower immigration are also in play. Economists now view the labor market as recalibrating to a lower average level, with private sector hiring momentum down, but still sufficient to sustain consumer demand, for now. The combination of weaker job creation, higher unemployment, and downward revisions to payrolls could increase pressure on the Fed to consider rate cuts in response to economic softness later this year.